My article this week looks into how the Brexit deal affects Oxfordshire house prices and your mortgage payments. Christmas Eve brought the news that Boris Johnson had conclusively agreed on a Brexit deal for the UK with the European Union. This gave optimism that the economic turmoil of leaving the EU would be radically reduced. Yet what will this trade deal do to the value of your Oxfordshire home and the mortgage payments that you'll have to make? Since the summer, the Oxfordshire property market has been booming, yet many commentators have cautioned that the momentum cannot last. With unemployment and the end of stamp duty on the 31st of March, the Halifax reported last week that they believed UK house prices would drop by at least 2% and in some areas 5% this year. I find it fascinating that the Oxfordshire property market has defied the doom and gloom swamping the wider British economy in the last 7 months. The property market here has profited from the large swell in demand from better off existing Oxford households trying to buy larger houses as they are required to work from home, together with the added benefit of saving money from the stamp duty. Oxfordshire house prices are 9.5% higher than a year ago, making our local authority the 15th best performing of the 396 total in the UK. With the Brexit deal being voted through in the Commons on the 30th of December, many say this will boost the property market just as the government-backed measures supporting the property market come to an end. Yet in the face of rising unemployment due to the pandemic, the Brexit deal may do little more to avoid uncertainty for the Oxfordshire housing market. What will happen to the prices? The Oxford property market in 2019 was held back because of the uncertainty of the Brexit deal. In January 2020, we saw the demand released in the fabled Boris bounce, only for buyer and seller activity to fall off of a cliff in March due to the first lockdown. It then took off like a rocket. Once lockdown was lifted, UK house prices are 4.19% higher today year on year, although in some areas like Aberdeen, house prices have dropped by 5.1%, and at the other end of the scale, Worcester's house prices have increased by 12% year on year. A lot of that growth in the UK property price has been fueled by buyers spending their stamp duty savings on the purchase price of their new home. Yet it cannot be ignored. Of the 78,000 workers in Oxfordshire, 4,800 are still on furlough, although roughly 40% are on part-time furlough. When the furlough scheme ends in April, unemployment is likely to rise to in excess of 11%, whilst the protection for the homeowners utilising mortgage holidays will finish. Piloting the rocky shoreline of the recession is more important than any Brexit deal for Oxfordshire homeowners, buy-to-let landlords, buyers and sellers. In April, the market will also be dealing with the end of the stamp duty holiday, which is due to come to an abrupt halt on the 1st of April. Consequently, we will continue to see the house price index show growth for the first half of 2021. They will then recede as the prices of Oxfordshire homes purchased after the 1st of April reflect the lower price paid because buyers would have had to pay for their stamp duty again. Therefore, probably by the end of 2021, the Halifax may be correct, and Oxfordshire house prices will be at 2% to 5% lower than they are today, simply because of the stamp duty. What will happen to the mortgage rates? The real benefit from the Brexit deal is that there will be no tariffs on most goods coming into the UK. 52% of all goods imported into the UK are from the EU, totaling 374 billion per annum. The UK government were planning to add between 2 and 10% tariffs under the World Trade Organization rules on the vast majority of those goods. Price increases because of those tariffs would have been fueled by inflation, meaning the Bank of England would have to increase interest rates, although 77% of British mortgages are actually on fixed rates of around 2%. To show you how vital low interest rates are, the average Oxford homeowner's mortgage is £782 per month, owing an average of £318,000. Yet if interest rates rose only 1.5%, Oxfordshire homeowners' monthly mortgage payment would rise to £1,180, and if interest were at their 50-year average, then the mortgage payment would be an eye-watering £2,300. As I've mentioned many times in the articles I've written about the property market, low interest rates are vital to ensure we don't have a property market crash. That's not to say just because they are at an all-time low of 0.1 to aid the economy that there won't be some sort of realignment of property prices later in the year. Yet low interest rates mean people can still pay their mortgages, so there won't be panic selling. That would mean there won't be a flood of property to come to the market like there was in the 98, 88 and 2008 property crashes when interest rates were much higher, suggesting property prices should remain a lot more stable.